We now have Jim Bianco, who will be presenting about just a general macro landscape, along with talking a bit about his thoughts on DeFi and crypto generally. Jim, are you there?
Yes, I am. Can you hear me? How do I'm coming through to you?
Yes, you are.
Hello, everybody. Thanks for inviting me. By the way, I'm coming to you from lovely Laguna Beach. We should all be in Laguna Beach right now. It's really nice here as well, too. Let me tell you a little about myself. I am a traditional CeFi guy who has been converted and sees the light. And the light is that DeFi is going to be the biggest disruption to the financial services area since the invention of the paper currency in 1693 by the Bank of England. And I'm not being too hyperbolic when I say that, it's going to be a very big deal. But I think all you guys know that. And so I'm not going to go through that, but let me share my screen. I do want to go through a couple of other things that I would like to talk about, because I am a traditional CeFi guy. I want to talk about the things that I see that I think would be relevant for you. So hopefully you can see my screen here. And I've got three topics I wanted to discuss. The US economy, because that's my strong suit, is very strong, and what could upset it is a potential COVID wave for a few minutes. The outlook for inflation is higher, and what is causing it is the mailing of money and the emergence of universal basic income. Now, let me stop there and say I'm not against at all helping anybody who needs help, but what I'm afraid of is there's going to be a consequence to what we're doing, and that consequence is going to be the devaluation of the US dollar through higher inflation. And then, since I am talking to a largely DeFi crowd, the biggest risk I see, I'm not going to talk to you about the mechanics of DeFi, you guys know more about it than me, is I see US regulators setting it up so that we're going to sit this out, we being the United States. They're going to tell you that AML and KYC rules are going to prevent anybody from doing anything in this space. And I just wanted to point out that there's 1.2 billion mobile registered money accounts in the third world, Latin America, Asia, and Africa. And they're going to set the standard if we're not allowed to play in that sandbox. And that's kind of where I'm really afraid of. So let me dig into a couple of these things, and I'll try and go about 20 minutes and then take some questions. Let's talk about the US economy. The blue line you're looking at right here is a rolling average done by Bloomberg of what economists think 2021 GDP is going to be. And right now they're thinking that it's going to be around 6%. The dots are the Federal Reserve's forecast. The last time they updated it was March 17th at 6.5%. These are monstrous numbers, and it's really surprising that the Fed is above the consensus of Wall Street. How big are they? This chart you're looking at here, here's that median forecast. You gotta go back to 1984 to see a period where the economy has been that strong. We're thinking that we're gonna see the strongest economy right now in 37 years. The world economy is at 5.6% estimated 2021 growth. That's the strongest since 2010. So the takeaway from these first couple of charts is, yeah, the economy is smoking hot and it is on fire. Why? Because COVID's going to end and we've got vaccines and we're going to all hit herd immunity through vaccines and we're all going to go back to normal. Except one little thing might be popping up along the way. Here's the daily reported infections from Johns Hopkins University. They're starting to go back up again. This is worldwide right now. So we're starting to see a little bit of an increase of COVID infections. Europe, Europe, here's 1, 2, 3, and a lot of people are worried that they are again starting in wave 4. So for all the hope that we're going to get this thing done, it ain't quite going away just yet. The US is bottoming a little bit. There's a little bit of a hookup in the last couple of weeks. Usually these types of things, when it comes to viruses, tend to trend. When it turns up, it doesn't act like a market, but it tends to be a little bit smoother in its ways going up and down. So it's got people worried that we might be on our way back up as well too. What about vaccines? So Bloomberg does a very good job of highlighting vaccines. 574 million vaccines have been dosed worldwide. The US is 147 million of that. 16% of the US has now been fully vaccinated. And a couple of countries to work worthy of looking at is Israel. 52% of their population has been fully vaccinated right now. Chile's at 18%. The UK is a little different. They've been pushing everybody on the first shots. So they're over a quarter of the people on the first shots. Second shots are to come, but they've got a very high percentage of people on the first one. So, okay, so the vaccine is coming, even though the case counts are starting up. Will that, how is that impacting everything? Well, let's take a look at Israel. Here's their vaccine count. Here's their daily dose, and the red line is a 7-day average. They're actually falling because they're running out of people to vaccinate. And guess what? Their case count is plummeting, and it's getting very close to zero. So when you get to 52% of the people vaccinated on a second dose, it goes down. The UK is at 26% at first dose. That has an impact. There is not an increase like there is in the rest of Europe as well too. But the problem is we're still months away from that. And Europe has been a complete disaster in the way that they've been doing the vaccine. They could be many months away from that, and they're going back into lockdown again. Today, France announced more lockdowns for the next 3 weeks. And so all this hope that we're going to have strong economy makes perfect sense, provided that this vaccine doesn't get in the way, provided that we don't have another wave and we get these vaccines out. So we're going pretty good with the vaccines, but we got to go faster. Otherwise, it might start to filter into growth. Last one I'll mention is Chile. Chile's got 26% of the first doses, 17% of the second doses. They're way higher than the US, but look at their case count. Why? Because Chile opened up. Chile said, okay, good enough. We got a vaccine. Everybody take your mask off. Let's go back to normal. And they're not quite there yet, and case counts are continuing to climb. So the economy is going to be great. What's the big problem? COVID's not behind us. We need to get the vaccines going faster. If we could get to over half of the population vaccinated like they have in Israel, then we can discuss it being done. That might not be until the second half of the year, or maybe the fourth quarter at the rate we're going. And that still gives us enough time to really disappoint markets with the economy. Second topic I'd like to discuss is inflation. I think this really plays into the DeFi crowd. So here's the Fed's favorite measure, core personal consumption expenditures. And inflation looks like on a year-over-year basis, it's not a problem. But we know that last March and April, prices plummeted when the lockdowns came. And we know that they're going to roll off in the next few months. And that's what economists have referred to as the base effect. So if you look at a 10-month annualized inflation rate, this takes out March and April of last year. And eventually, when you add in, I'll add 11 months in a full year, we're at 2.34%. That is a 13-year high and one of the highest levels we've seen in the last quarter century. So what we're expecting is that the inflation rate over the next couple of months, is going to really shoot up a lot. And it's going to shoot up well over 2%. Again, everybody knows this. It's called the base effect, and everybody's somewhat dismissing it. But I'd be worried about dismissing it. The regional Federal Reserves do surveys of the businesses in their districts. So here's Dallas, the Empire, which is New York, ISM, which is the Institute of Supply Management, that's a national survey, same methodology, Kansas City Fed and the Philly Fed. They ask prices paid. And they ask you, it's a diffusion index. They ask you, are you paying higher prices, same prices, or lower prices than the previous month in 3 months? And I measure this as a Z-score over the entire period. How many standard deviations are they away from the average? Currently, we're at the highest level we were at since July of 2008. And if you go all the way back 41 years, this is one of the highest levels of prices paid, a measure of inflation we've seen. By the way, July 2008, price of crude oil was $147. That's what drove that. We don't have crude oil at barely less than half that price. So that's everything else. So there's definitely a sign that inflation is coming. Where's it coming from? It's coming from the Fed. The Fed's balance sheet as a percent of GDP has been skyrocketing. It's over a third the size of the economy. Back before the crisis began in 2008, the financial crisis, it was at 6% the size of the economy. So it is over 5x larger, and it is essentially doubled in the last year from the pandemic. So the Fed has been printing tremendous amount of money. The federal deficit is one of the largest we've ever seen. It's $3.5 trillion, or 16% of GDP. Although this chart only goes back to 1968, the last time the federal deficit as a percent of GDP was this big was 1944, was when we were financing World War II. And this is other than that, this is the second highest period in American history. So if you look at this chart here, yes, this chart goes back to 1787. The Office of Management and Budget did put together these statistics, looking at how big the economy, how much the federal government spending is as a percentage of the economy. In 2020, it was 33% of the economy. Again, only financing World War II was the largest it's ever been in the 200 and nearly 50-year history of this country. So we are spending money like crazy. We are borrowing it, we are printing it to a level that we've never seen. And how's that showing up? This, I think, might be the most interesting chart of all when it comes to it. This is personal income made up by government transfers and assistance payments. So let me explain this. Personal income runs at around $21 trillion a year. The biggest part of personal income is your salary, your wages, and then your investment income and anything else you might get in terms of income. What percentage of that is made up by, as I'd like to say, is the government just mailing it to you? Whether it was Social Security or disability or food stamps or some other kind of assistance. And now in the post-pandemic era, you can add in the $1,200 for CARES Act, the $600 checks that went out in December, the $1,400 checks that went out in the last few weeks. It was 31% of all the income of the United States was mailed to everybody through the CARES Act $1,200 checks. It got to 27% with the $600 checks. This chart will probably need to be rescaled in the next couple of months when the $1,400 checks are added into this as well too. Over a fifth of Americans' income is mailed to them by the government right now. Unprecedented in any time in American history. This chart goes back to 1960 as well too. And what's that leading to? That's leading to a monster savings rate. We all know the Robin Hood effect. Everybody's putting their money in the Robin Hood and they're buying stocks, and that's pushing up stocks. There's a tremendous amount of savings that people have that once they feel comfortable, they're going to start spending it. And that's inflation. And that's going to be a big problem for them as well too. And as I've liked to say, if there's no consequence to this, and I want to be clear, I'm fine with helping anybody in any way I can. But the question is this a consequence-free way to help people? And that's really the issue that I have with it. Sure, if you want to print and borrow money and mail people that are in need money, there's got to be a price. And that price, I fear, is going to be the loss of purchasing power via inflation. But wait, we've done that. We're not going to continue to do it. Yesterday, this is a story from yesterday. 21 Senate Democrats urged Biden to put reoccurring stimulus checks and unemployment aid extension in the infrastructure plan. They're referring to this as human infrastructure. This is UBI, that they want to start talking about permanently mailing people money every month. Hey, if the modern monetary theories are correct and we could do this without the consequence of inflation, that's fine. But I have a feeling that we're not going to see the consequences. That we're not going to see that. We're going to see the consequences show up in inflation. And again, we've mailed out 3 sets of checks. We're talking about mailing out more. And if there's no consequence to it, meaning something bad didn't happen, because right now the poor are getting help, the unemployed are getting a bridge, and the rich, defined as anybody who owns equities, is getting new highs, mail me more money. Because all mailing money does is it makes things better. As well, is the way it looks. Only when we've gone too far and we've created inflation will we stop, but at that point it's too late. And it's going to be really hard to put the genie back into the bottle. Final topic I want to talk about is my perspective on DeFi. And I'll start with this chart here. This chart indexes to July of 1998. That was, for those of you old enough like me to remember, was about a month or so before long-term capital crisis, long-term capital management, LTCM, had its crisis and blew up. It was kind of like the Archegos problem that we're having this week, but at a much, much bigger scale as well too. Since that period of time, in the last 23 years, the bank stocks have been terrible investments. The European and the Japanese banks have lost you 63 and 73% over the last 23 years as the stock market is up a lot. American banks have returned you 30%. But to give you an idea of how that works out, the black line is 3-month T-bills, which spent most of that period at 0 interest rates. If you had just rolled your money in cash, getting 0 interest rates, you'd still be up 55%, and the banks are up 30%. So what I'm trying to show you here is the worst long-term investment you could have picked in the last 25 years of the major stocks in the S&P 500 have been the financials. They have been a disaster. If you look at the larger financial index, since the financial crisis of 2007, they have barely returned you a positive return, up 12%. Everything else is up 225%. So what's this telling me? The market knows that the business model of the current CeFi system is broken. It has been broken for a long time. It may not know what's going to replace it, but it knows this doesn't work. And that's why people that invest in financials, I've joked around, is financial stocks have been created to make money managers former money managers, because that's all it's largely done to them over the last several years as well too. So in its place comes DeFi, and in its place comes cryptos. So the blue line on this chart shows you the market value of all the banks in the United States. And I updated this chart about 3 hours ago. And the orange line is the total crypto market cap universe. It's about to cross. That the crypto universe is about to be larger than the value of all United States banks. It was very close 3 hours ago. And I noticed that we're up a little bit more since then, that it might have actually crossed for the first time ever. This is a market signal. And by the way, if you want to know, this is how it breaks down. That's Bitcoin, and that's everything else right there as well too. This is a market signal that this DeFi universe, this crypto universe, is the new financial system, and it is coming, and it is going to replace it. These guys, these banks here, these are taxis. These are taxis. This is rideshare, is the way that I've been explaining it to my CeFi friends, and that you can't do away with this. Oh, the biggest problem that they have is, oh, it will be banned. Oh, the government won't allow it. Look, you said the same thing about rideshare. The mayor won't allow it. It gets too much money from the taxi business. They're all corrupt. They're going to continue to force you to take this crappy old yellow taxi, and they're not going to allow you to take an Uber car. But it became unstoppable as well too. And that's what gets me to my worry. And that's the last part of what I wanted to talk about. It is unstoppable. It is going to happen. It is the revaluation or recreation of a new financial system altogether. And if we don't play in it, it's going to be created by others. How is it going to be created by others? They have the means and the ability to do it. So let's take mobile phone subscriptions put together by the International Telecom Union. This is the number of mobile phones per 100 people. If you're over 100, that means you have more than one mobile phone per person. The United States is 134, 1.34 phones per person in the United States. A lot of us have 2 phones, a personal phone and a work phone, and burner phones, and that's how you get over 100. In Asia, it's 129. In the Middle East, it's 116. In Latin America, it's 100. And in sub-Saharan Africa, which is probably one of the poorest places in the world, 87% of people have mobile phones. Everybody has a mobile phone everywhere as well. And those mobile phones work. If you've ever been outside the United States and tried to use a mobile phone, the first thing you realize, and I won't mince my words, is how shitty the service is in the United States. The third world service of mobile phones is located in New York City. It's located in Laguna Beach, where I'm at right now. According to All Connect, the US ranks 38th in mobile download speeds and 95th in mobile upload speeds. Albania has better speeds than the United States. So the rest of the world has the tool, here's my phone, has the tool in their hand in order to use DeFi. Well, what about sending money, money? Well, GSMA, the Global Standard for Mobile Association, puts out a statistic every quarter, the number of mobile money accounts registered. I looked at just Latin America, the Middle East, Asia, South Africa, South Asia, and Africa. There are 1.2 million accounts that are registered. Well, excuse me, let me rephrase that. 1.2 billion mobile money accounts. Now, these are traditional CeFi accounts where you can send money back and forth as well. Of those 1.2 million, 430 million of them were used in the fourth quarter of 2020 alone. So let's stop with this idea that the third world, I'm talking about what my CeFi friends tell me, they've watched too many movies with Leo DiCaprio in it, Blood Diamonds is what I'm thinking about. They think the third world is just a bunch of people basically bribing border guards with diamonds to get themselves out of these terrible countries. No, they're all walking around with LTE connections on iPhones, and they're texting money back and forth to each other to a greater degree than we do in the United States. They do that now. So if you're going to introduce to them a new digitally permissionless, decentralized financial system, they're ready to go. They're ready to go right now. Just show them what app they have to download and go with, and they're on their way. If you look at a number of studies that have been done of who buys cryptos, it is third world countries that have the highest level. Nigeria, in 2020, a survey was done. Nigeria said that 32% of its population had either owned a crypto or currently owns a crypto. In the United States, it's 5%. So they're all ready to go with this as well too. So when I hear and I see, our regulators talk about, AML rules, which is anti-money laundering, KYC, which is know your customer rules, that we have to be careful with this, that they summarily announced that Bitcoin can't be a medium of exchange, and they're setting up to basically tell everybody you can't use it. They're telling everybody to sit this one out. We sit this out, the rest of the world is going to create that standard, and they're going to force it on us. Oh, but what about these regulatory rules? Well, GSMA has this neat little chart that they put together of a regulatory index, and it shows, where regulations are very high in the United States and in Europe, also in China, interestingly as well too. And they show where regulations are very low in South America, in Africa, in the rest of the Middle East as well too, and in Asia. Where those 1.2 billion accounts are, that 430 million of them, mobile money accounts, were used on mobile phones. These people are fine with the idea that they don't have stringent AML KYC rules. Show them how it works, and they'll be off to the races. So my biggest concern when it comes to this whole DeFi space is our regulators are going to make a giant mistake, and they're going to force us to sit this out. And if they do, the world is going to set the standard. Oh, but they don't have the money. No, but in the Middle East, they'll tell us that this new standard, we got to pay for it with crude oil. They're going to tell us that we're going to have to buy raw materials with this new standard as well too. Finished products out of Asia that Walmart buys, that puts on their shelves. They're going to have to pay for it with this standard. And if we have no say in developing that standard, we are going to lose. The biggest reason you hear Americans push and Europeans push, because they're the winners in the current unfair CeFi system. They don't want it to change. But it's not a question of whether or not they can prevent it from changing. It's going to change. The question is whether or not they want to play along with it. And my fear is that the regulators are setting up, and I'm talking about Janet Yellen, Jay Powell, the Biden administration, with the exception of Gary Gensler, who I think gets it, but he's one voice, and I hope he's the voice that will win the day, but I'm not so sure he will. That they think that they could shut this down and keep their current system, which is unfair but benefits them, going, and everybody will accept it. Kind of like mayors thought, oh, we'll just shut down this rideshare thing. And don't worry, you yellow taxi guys and you checker taxi guys, you'll be fine. We'll take care of you. But in the end of the day, they couldn't. It became unstoppable. So that's my biggest fear about with DeFi. Let me stop there. And let me say that I did send my slides to Emran. So if you didn't get a copy of them, he could maybe forward them on to you. And I'll open it up for any questions that anybody has. I'm looking at some of the questions in the chat right now. I guess, is that the way I'll take the questions, is just take them out of the chat? Let me see if there's
Yes.
any,
Anyone,
ahead.
if anyone has actual questions, I can unmute you and you can ask questions directly, or we can have Jim continue with the presentation.
Yeah, I mean, I'll just read some of the questions out loud. I'll just read some of the questions out loud and try and answer them as best I can. Opinions about whether the question isn't if inflation or whether it is about current metrics capturing inflation. Now that's a good question. There is an issue that I'll mention to you about inflation. Typically, the way the government measures inflation is they send physical price checkers out to brick and mortar establishments to actually look on the shelf, to actually look at what the prices are. That's the way they do it, but not in the pandemic, because you can't, because brick and mortar places are closed and the price checkers aren't able to do it. So they've literally said they're either looking online, or they're calling up the stores, or they're estimating, which means wild ass guess. Now, maybe that's not a bad way to do it, but it's a serious break from the way that they have done it. So we don't know what inflation would have been a year or 2 or 3 years ago on this new system that they're doing right now. So it is a different way that they're doing it. And so, yeah, the metrics, I don't know if they're missing inflation, but they're different. They're definitely not the same that they were before, as far as where we're going from here. And that needs to be understood as we look to inflation. Look no further than interest rates. Interest rates have been relentlessly rising since August. And one of the big debates that we're having on Wall Street is why are they rising so much? And the answer is because I think the market is getting more and more worried about inflation. And the reason it's getting more and more worried about inflation is because we just keep sending everybody money and we keep stuffing them full of money. And whether or not we get to herd immunity through vaccines sooner rather than later, we will eventually, and everybody's gonna have money to spend, and we're gonna have a lot of inflation then at that point. And that's been what the fear has been as well.
Jim, you had a
question. Yeah, go ahead.
I'll pass it over to Akin. Akin?
Yeah, hi, Jim. So going back a few slides to where you're talking about inflation. So it sounds like, if inflationary policy continues, that continues to sort of provide fuel for, crypto and DeFi. But what happens in a scenario where rates start getting tightened because, inflation just starts to show up, right? You talked about the consumer starting to spend once confidence comes back and, COVID gets addressed. Does that just wreck the stock market? And, because now valuations will have to, take into consideration a different discount rate. And if that scenario does happen, like, how do you see that impacting crypto and DeFi?
Yeah, so I think you're right. This is the concern, is that rising rates, if it is interest rates going up, let me start this way. Interest rates going up is neither good or bad for traditional financial assets. It's why. If interest rates are being dragged up higher because you've got booming growth, everybody's getting a job, people are getting more money, they're feeling more confident. Okay, the financial assets can tolerate higher inflation. Higher interest rates. If they're being driven somewhat by inflation, and let's remember, we haven't seen that in 25 years. That's not so good. That's a loss of purchasing power. That is a lower standard of living. And that would be greeted poorly by financial assets. You're starting to see the beginnings of that as interest rates have gone through 1.5% on the 10-year note. The tech stocks, which are considered long duration assets, the the ARC type of companies, the NASDAQ 100 type of companies have been wobbling a little bit lately because of higher interest rates. And that's because it greatly impacts them. So if rates go up because of inflation, which is what I'm fearing, although the Fed will tell you, no, it's going up because everybody's broken out into, of course, God bless America, and it's all a great place, and that's why rates are going higher. But if it is about inflation, it won't be treated well in the financial markets. It will make the stock market more volatile. It'll make it go down. It'll make it more difficult to be an investor in that area. And it will benefit the crypto universe because the crypto universe will be sitting there saying, see, there is problems here in this permissioned world that the permissioners, if I could use my bad language, have made errors. They've made errors in judgment, and we all have to pay the price of it. And we've got this new permissionless world that's coming that doesn't have those problems. So I think it would be a benefit to it. And that's why I think what you've seen with the big rally that you've seen with cryptos in the last several months has come on the back of higher rates, has come on the back of this fear of inflation as well too, because it is a concern that we're going too far and there is going to be a price to pay. And there is an alternative that would have said you would have never paid the price here had we been in charge. Hope that answers your question. If you have a follow-up or any other questions as well too. Let me throw out a question. What will it take for regulators to fully accept DeFi?
Jim? Might have lost you. We'll wait for him to hop back on. He's joining in a minute. We'll give it another minute or two. He said he's going to join back up. Sorry for the delay there. Must be, there he is. Let me unmute you.
I'm back. Can you hear me? I'm back. Can you hear me? Can you hear me and see me? Okay, good. I apologize for that. That was the Bill Gates blue screen of death that jumped on me right there. I guess I shouldn't be using that product, but I should be using the MacBooks, but I don't. I use a Surface. But I'm back anyway. Let me answer the question I was about to answer right before I crapped out on you. What will it take for the regulators to accept DeFi? An understanding that they can't stop it. They think they can control it. They think that they can control it, including killing it. They think they will decide when, how, where, why, and by what method DeFi will be created. Look at the Federal Reserve. The Federal Reserve last year announced that they're going to create a version of FedCoin. And how are they going to do it? They're going to have it ready to go in 5 years, in 2025. They're going to, and they said that they want to make sure that it's stable, it works, it doesn't give anybody any problems. So this is how they're going to do it. They're going to take 2015 technology. They started it in 2020, and they're going to introduce it to the world in 2025. It's not going to work. Oh, they'll have a Fed coin, but it won't really work. It won't really amount to anything. And neither will any CBDC ever amount to anything, because they're all going to try and do the same thing. They're just going to try and create the CeFi world with a little bit of a digital coin, but not really change anything. So I think in order for them to accept it, they have to understand it is happening with or without you. And you might as well get on board. Gary Gensler, the head of the SEC, the former head of the CFTC, completely gets it. He's one voice of many. You know who doesn't get it? And she has said she does not understand this stuff at all, 1 inch, is Janet Yellen. Does not understand this stuff in the slightest. Joe Biden does not understand this stuff in the slightest. Kamala Harris does not understand this stuff in the slightest. Hopefully they turn to Gary Gensler and say, explain it to us. And he tells them, this is the world that's coming. We got to get on board. Instead of them thinking, this is the world that we have to squash and get rid of and push off to the side and marginalize. Because if that's what they think they can do, they're never going to let us get on board. So that's what it's going to take to get regulators on board, I think. It's just an understanding that this is happening and that this is not going to, they cannot stop it any more than the mayor of New York can stop Uber. Once he realized he couldn't stop Uber, and once he realized he couldn't regulate it out of business, then they just started to accept it then at that point. Any other questions or any other follow-ups to that as well? I lost all the chat before I rebooted, so.
Yeah, there's many questions, but I know we had originally scheduled for 30 minutes. I don't know what your time is, maybe another.
I got a few minutes to answer questions. Is there anybody behind me that we're holding up?
No, you're the final.
I can answer questions. You know, I can run into the overtime answering questions if you want. So go ahead.
Perfect. So if everyone can, repaste their questions again, that'd be great.
Yeah.
But the first one is, how do you think DeFi and stablecoins can impact emerging market currencies as they are weaker compared to dollars, especially when we can get yields in dollars and simply convert it when we need it?
I think though, repeat that question one more time because you broke up a little bit on me on that.
No worries. It's in the text box if you can see it as well. It starts with Jim and Andre from Brazil here.
Oh, yeah. Okay. How do you think DeFi and stablecoins can impact emerging market currencies as they are weaker compared to dollars, especially when you can get yield in dollars and simply convert it when needed? I think the biggest thing that you could see what will happen with a lot of the stable currencies is a lot of the rules that you have associated with getting dollars and converting those dollars as you want to your local currency will go away. Look at an extreme case like Venezuela as well too. There's been instances in Venezuela where they've threatened to jail you if you walk around with dollars in your pocket. That will be done away with in a stable coin kind of world, especially when you've got an encrypted account on your phone. Police can take your phone and look at it all they want, and they're not going to find anything on it unless you give them your password as well. I do think, though, that once you get into this whole new world, especially when you get into staking and liquidity pools, It's going to change the equation on getting interest rates and getting yourself some kind of, it's going to change everything in that regard. But what it's also going to need to happen when you get into that world is hopefully you start introducing, let me call it the real economy. You know, you get real companies to say, I'm going to use this DeFi world as a source of financing and a source of payment. We've got, you know, the beginnings of that literally this week with Visa now accepting stable coins on the Ethereum platform to get paid. The adoption is definitely coming. But once you get that more of an adoption, then I think you're starting to move more towards a currency that's a lot more stable, a currency without a lot less permission that you need right now. And I think it would be a big benefit to the emerging market. Look, you guys out there in the emerging markets, you already have your phones, you have your fast connections, you have your mobile money accounts. You know how to do this. Just need to be told what app to download and start doing it, and away that you go as well too. Let me take a couple more of these questions. What happens in the incumbent sectors when the USDC as a percentage of foreign reserves substantially decreases? That depends. That depends on what David Solomon of Goldman Sachs and Jamie Dimon of JP Morgan decide to do. Now, Jamie Dimon famously said that he would fire anybody who traded cryptos in 2017 at JP Morgan, and now they're creating JP Morgan coin. So his thinking has come a long way in the last 4 years as well too. And Solomon and Dimon, their biggest concern right now, what are they talking about right now? They're talking about getting everybody back to the office for 60 hours a week, because that's what they believe needs to be done, that everybody who works for their bank has to be chained to their desk 10, 12 hours a day in the office in a big building in Midtown Manhattan. So they're not thinking, I don't think, properly about this. So you're asking what incumbent sectors of USD happens when reserves substantially decrease. It depends on whether or not they want to continue to fight for the CeFi world and continue to hold on to that, or if they want to let go and start joining the DeFi world. Now, they let go and start joining the DeFi world, they're going to lose because they've got all the power right now. So I suspect that they're not going to do that. They're going to fight. They're going to fight because that's the current setup benefits them. And they like it the way it is. It benefits them. They want everybody at their desk 12 hours a day working on the current settlements. That's what they want. They don't want to think about this other world. But you know what? Outside the United States, in Latin America, in Africa, in Asia, in the Middle East, they're all ready for it. They're all ready for it. And that's where I think it can come as well too. So they're going to fight it initially, and they're going to lose initially before the thinking gets changed around with a lot of this. Many proponents of money printing claim it isn't money printing because it doesn't increase the currency in circulation. These same proponents have never talked about asset inflation. Have you seen a good measure of asset inflation? How does QE fiscal policy actually lead to asset inflation? Any specific mechanistic examples? Yes. The Federal Reserve will tell you that money printing, which is the vernacular for QE, which is expanding the balance sheet. And let me be clear here on what they do. Every day, the Fed calls up a bunch of banks that are the primary dealers. And they say to the bank, sell me some US Treasuries. And they sell JP Morgan, to use another example, same example, sells the Fed $100 million worth of US Treasuries. Well, how does the Fed pay for it? JP Morgan has a reserve account with them. And the Fed could just go in there and say, we'll just change the number in your reserve account and add 100 million to it. That's how they pay for it. That's what the money printing is. That's what QE is. We will buy up all of these treasuries and we'll just change the number in your reserve account. A friend of mine once called it legal counterfeiting. That's what central bankers do, is legal counterfeiting. And that's a pretty good description of what it is. That suppresses interest rates, that holds them down, that forces people in the rest of the investment world go, well, I don't want to own these low yielding instruments. I'll look out to take more risk. I'll buy some corporate bonds, or I'll buy some high yield bonds. And then those rates go down, and then those people look to take more risk and they'll buy equities. And then those go up, and then they'll start to buy, over the counter equities. And so that moving out the risk curve continues. So that's how QE works. So the Fed will be somewhat disingenuous. We don't buy equities. Of course you don't buy equities. You suppress interest rates and you force everybody else looking for a return to take more risk. And that's how equities get impacted by it. You don't get your hands dirty on that. You start with the base level of treasury and interest rates and you keep them suppressed. And if you're Europe, you've got them negative. You've actually pushed them negative as well too, to try and force people out the risk curve as well. So that's the best example I can give you for it is two. Governments live on tax revenue. How do you imagine governments can collect tax in a DeFi transactions world? There's a thing called a use tax. If you're very, very wealthy, you're familiar with the term use tax. If you buy an expensive painting or if you buy a $69 million Beeple, you might get bagged with a use tax. The act of owning it, they will impose a tax on you. They can use tax you. They can use tax you because you own a car. So you're going to pay a tax on that. They can use tax you because you own a house. They'll use they'll use tax that as well too. So they could move from income tax and other forms of financial revenue to the fact that you own something and put a use tax, the fact that you use it. You own that picture and it's on your wall. You have to pay for it to be on your wall. It's legal. It's not very well used because it's hard to use a use tax. That's why it's only used in extreme examples. If you buy a $50 million impressionist art painting and you live in New York or California, they can bag you on a use tax on that. But they're not ready to go all the way down and say, well, you know, there's 88 million cars in the country. Why don't we use tax the 88 million cars? But once they've lost their revenue source from traditional financial revenue, they could go that route as well too. How specifically are you advising your clients to participate in DeFi at the moment? Or are you yourself using DeFi on behalf of your clients? I am using DeFi personally. I am yield farming. I am staking. I bought an NFT. I'm trying to learn the process for myself, and I've been doing that. I've been involved in crypto since 2017. I've been involved in DeFi since DeFi summer as well too. What I'm telling my clients are traditional CeFi clients. They're older. They understand the CeFi world. I am literally trying to tell them that you need to open up your mind and start to understand this stuff. I'm at that stage. Accept it. Accept that this is there and that this is real. You know, I don't feel qualified to be the guy that mechanicalistically is going to show them, you know, how to open a MetaMask wallet and how to do this stuff that way. There's others that can do that. But in my role, I've been trying to just say to them, quit trying to dismiss this. Or in a lot of cases, they've never heard of it until like a month or so ago as well, you know, and understand that this is a big deal. And don't find ways to try and say that it's not going to last or something along those lines. So that's where I'm at with my client base. But most of my client base, I do talk to them a lot about traditional CeFi stuff, you know, whether the stock market's going to go up or down, or what interest rates are going to do, what the Fed is going to do, what impacts those types of things. Is inflation going to come back, growth in the economy? That's what I spend most of my time talking to them about. And along the way, I'm trying to explain to them, if you want to look over the hill longer term, this disruption is coming. And it's one of my slides showed. I said, why do you think the bank stocks have been such terrible investments for the last 25 years? They didn't know DeFi was coming. They just knew that model didn't work. That's what the market was saying. This model doesn't work. We don't know what the model is going to replace it. Now I'm starting to see the model that can finally start replacing it. If DeFi returns is one of the key drivers for mass attraction and adoption, do you think the returns are sustainable in the long run? They are, if you get mass adoption. If you get the traditional world in order to, you know, if you get companies to start looking at that as a source of financing, a source of payment, a source of investment, and that it isn't run as a parallel to the real economy. It is being run as a parallel to the real economy now, because I see it as being a way to stress test it. So the AMMs and the liquidity pools, they need to be, you need to show that they work. You need to show that they work and that they can handle volume and that they're ready for prime time. So that's where their use is and their importance is now. But eventually, if you really want to get these things to really blow up in huge size, you need to go to the Fortune 500 companies and say, okay, now we've got a way that you could finance yourself, and you can accept payments, and you can make payments, and you can consider your treasury to use these tools as a form of investment as well too. That will come over time, and I know more and more, literally every day, people are starting to look at this stuff and starting to starting to think about that in the longer term. A lot more than 90 days ago, a lot more than 6 months ago, a lot more than a year ago, and in 30 days, 90 days, and in 6 months, they're going to be even thinking about this a lot more. In terms of long-term global outlooks, what are your thoughts regarding Ethereum as opposed to Bitcoin as sound money, given the upcoming changes in Ethereum's economic structure? So I know EIP 1559 is coming, and layer 2 scaling is coming, and ETH 2.0 is coming, and I know all that stuff is coming, and it's going to help to lower the gas fees, which I think is going to be critical, because I think one of the biggest problems I have with the CeFi world is, okay, I'm all in on this, Jim. I'm going to go open up a MetaMask wallet. I'm going to start doing this, and then I get a call the next day later and go, holy shit, look at these gas fees. This is not going to work in the long run. Like, be patient. They're going to fix this stuff as well too. But to your point about Bitcoin, if I can make a statement, people I detest the most are the Bitcoin maximalists that think that everything else has to go to zero and all you need is Bitcoin. Look, the day that everything goes to zero except for Bitcoin is the day Bitcoin goes from 60,000 to $5. Bitcoin needs DeFi, and DeFi needs Bitcoin. Just like the current CeFi system needs gold, and gold needs the current CeFi system. It is a store of value. It has an important role. But to argue it is the only thing you have, they're just like the gold bugs that think that all you need in your life, they're Peter Schiff, all you need is gold and nothing else. All you need is Bitcoin and nothing else. That is a mistake. They need both of them together. Bitcoin will be the store of value. Its price can go to the market cap of gold, which would put it, well above $500,000, maybe even closer to $1 million. But Ethereum and the DeFi world, that's going to be the engine of the financial system. That's going to be the payment system. It's going to be the investment system. That's going to be the insurance system. It's going to be the lending system, the borrowing system. And that can really collectively go. Now, one of the things people have asked me about with that is, well, how do I invest in it? I said, well, that's the problem. There's all these protocols. There's the Binance Smart Chain. There's Polkadot. There's Cardano. There's the Ethereum network. There's more coming. I don't know who's going to win. So a lot of people say invest in everything. And even if 95% of it goes to zero, the few that are going to win.
Hey, Jim. I think you're on mute or can't hear you. Your AirPods, maybe? I'm not sure. It's on mute. So I'm going to go ahead and unmute. There you go. Not yet, still. Not yet. Here, let's try this. I try unmuting. There you go.
How about now? Can you hear me now? Hello?
Yes, we can hear you.
No, I can't hear you.
Can you hear us now? Can you hear us now?
Hello? Can you hear me now?
I can.
Okay. Is the quality okay now?
Quality's fine.
Okay, good. I don't know what happened. I didn't touch anything, but I did give me a little error. All right. So I forgot where I was, but at least I didn't blow up this time. See, this is what happens. I'm in a resort, and this is what happens when I use the resort resort's connection as well too.
No worries.
So I was talking about Bitcoin and Ethereum, and I'll just conclude with that idea. I will just conclude with that thought that they both need each other. Just like gold needs CeFi and CeFi needs gold. You can't have one without the other, and that they work better in concert. And somebody else asked the question, Bitcoiners are convinced that all DeFi will eventually be built on Bitcoin as opposed to Ethereum. Well, okay, show me the smart contracts that are built on Bitcoin. I'm ready to see them. I've been waiting here. It's only been 11 years, and I'm not sure how that is going to work. But like I said, there's going to be a lot more standards and a lot more protocols coming in the future. And only one or two or three of them are going to win out and be the standards. Like I was saying, I remember what I was saying before. We had 100 automobile companies in 1900. We knew that the automobile was going to replace the horse and buggy, even though the buggy whip manufacturers were saying that these automobiles are terrible, they break, they're uneconomical, but we knew that they were coming. But by 1920, we were down to 4 automobile companies and then eventually the big 3. And that's where we are right now with DeFi. There's going to be dozens and dozens and dozens of standards, but only a few of them are going to win out. Maybe it is the ones that we have now, or maybe it's a standard that hasn't been created yet. But the point that I've been trying to tell people is one of those standards will win and will be the backbone of the new financial system. And it won't be a name of J.P. Morgan regulated by the Federal Reserve. That I don't think you're going to see. That's what I think you're going to continue to see as far as where we go from here. Another question is, what are the biggest problems DeFi needs to solve to cater to the large institutions and companies? That's an easy one. I think it's the front end. Look, I consider myself to be computer savvy, probably not as computer savvy as a bunch of you guys are, but it's hard. It's hard to open an account, basically start off in Coinbase and buy some ETH in Coinbase, and then open a MetaMask account, transfer it to MetaMask, connect to a DeFi protocol and do some yield farming or do some staking or put your money in a liquidity pool. I always, every time I do it, I keep thinking to myself, how do I explain this to my mother? How do I tell my mom, stop getting zero in the bank and go put your money in a liquidity pool on Uniswap? But you got to open up an account in MetaMask, but go through Coinbase to get your ETH into there. There's no chance whatsoever that can happen. 90+% of the country, I think, is going to look at this stuff, attempt it, and just give up because it's too much. I understand that the standards are changing so fast that nobody wants to sit down and write a neat front end. Maybe Dharma's got a good one. I was looking at that the other day. It seems promising, and this stuff keeps coming every single day as well too. But you've got to make it so that some of my customers who are executives at CeFi companies, they think high technology is a group text. How am I going to get them to open up a MetaMask account and connect to Uniswap and then stake some of their coins? I don't know if I can, but you got to make it so that it's easy enough for them to do. So that's what I think this business needs. That's what I think this business needs in order to bring in the rest of the world. But I understand no one wants to sit there and write that front end, because by the time you're done with it, the standards have changed 3 more times and you're always playing catch up and you're never on top of things. Back to inflation. In the long, medium term, would producers be able to pass prices on to consumers? I think the best way to answer that question is, do they want to? For the last quarter century, if you've been a manager of a traditional company, you've been taught that because of Google, because of Amazon, if you sell a dishwasher for $599.99, and somebody else prices their dishwasher at $599.95, 5 cents less, 4 cents less. On a Google search, when they sort by lowest price to highest price, you're on the second page. because everybody's at $599.95 and you're at 99, you're not going to get any sales. So you've been taught to never, ever, ever raise your prices, because if you raise your prices, you're going to lose tons of market share. So you find other ways to do it. But if we break that psychology and that I have to raise prices because my raw material prices are going up, the demand for stuff is going up. Look at the way we deal with it now. And not, if you've ever gone to a furniture store, I happen to be into bicycling. I own a couple of road bikes. If you go and try to buy a road bike right now, you go in to the bike dealership, and there's the price, and it's the lowest price on the list, and you sign up. Fine, you'll get your bike in some cases in a year. In a year is when you'll get your bike. Why? Because they're rationing them instead of raising the prices. And that's because they've been taught to never, ever raise prices, because if you do, you lose market share. If you raise the price of that road bike by $100, I'll go buy a different one that's $100 less. So to answer your question, in the medium long term, will the producers be able to pass along high prices to consumers? Yes, but will the producers want to? Because they're so afraid. But once the psychology is broken, and the Fed calls that unanchoring, then I think then we're all in a whole new ballgame then. And we're in a ballgame where everybody's managing against prices, and raising prices is acceptable. Right now, it is not acceptable at all to raise prices. And that's what the Fed is banking on. But that's the risk that they're facing, is that they're going to put everybody in an intolerable position, and that they're going to have to finally raise prices. As well. Procter & Gamble just raised prices on diapers and a lot of other things just the other day as well. So, and that was considered verboten even a year or two ago. You never raise the prices on that stuff. And so we'll have to see how that goes. But really, I think the question is, will they? Because if I'm an executive at one of these companies, I became an executive by understanding that I never, ever raise my price, because I have to be on the first page of a Google search, lowest to highest price. I'm never going to sell anything. And that's why that mentality, I think, is still holding in place. I'll find ways through technology and other ways to cut my costs in order to keep that price. But if we start getting people raising prices, we're going to be in a whole new ballgame as well, too.
Awesome. I know we took up some of your time during your vacation, so I don't want to take up any more of your time. But we really appreciate your time and some of the thoughtful answers you gave over the past hour. Any final words, Jim, that you'd like to kind of give to the audience or to the DeFi crowd before we end our session?
Yeah, at Bianco Research, or follow me on LinkedIn as well, too. Shoot me off some questions and some comments. I talk about a lot of these subjects there online.
Awesome. I've also shared your Twitter and your website in the chat group, and your LinkedIn was shared earlier. So we're all
good. Thank you. I'll talk to you guys later. All right. Really, bye-bye.
Take care. Bye. And thank you all for the attendees that have joined. We'll be publishing our recordings here very shortly. Thanks so much.